The more important fundamental aspects are in what we're going to cover here. We've got Target, we've got Home Depot, TJ Maxx, a surprise there. We've got Bitcoin, and of course the Federal Reserve. The Fed's minutes just came out, which of course are making an even bigger mess out of it. Because what does the central banks do better than anything else? They introduce uncertainty into just the marketplace, commentary, and basically everything in between. So we got the Fed minutes to go over. Do I have to pull the Pringles can off of the desk here? Whole lot to get into, and it's, like Nvidia is important for the stock market, but like I said, there's vastly more important stuff going on in terms of macroeconomic fundamentals as it relates to consumers heading into the all-important Christmas season, and a lot of that is going to be driving sentiment, which is sentiment where we get into what's going on with Bitcoin, further crash in crypto there. So let's go over everything we got today. Starting with, I think we'll start with Target here. Give me just a second. Vastly more important. Yeah, we're looking at the consumer sector, and Target, like you said, Target, Home Depot, TJ Maxx, which somewhat of a surprise for a lot of different reasons, but there's a sense that everything is bet on Nvidia. What is it they called it on CNBC today? The Super Bowl for the stock market. And I think that's great for the media, and that's great for, commentary and things like that. But the stock market is hit a bit of a wobble here. And I think in a lot of ways it's being driven by the fears in cryptocurrency and what crypto is picking up as far as risks in the marketplace, risks of investing in risky assets in the marketplace that is being driven by, the flat beverage curve, which also relates to the consumer segment of not just the stock market, but the overall economy. So even, mainstream media sources, Walmart, Target, Home Depot overshadowing Nvidia in a very fundamental way, even if Nvidia sucks up all of the mainstream traffic. And even you go back to last week, as they point out here, consumer discretionary stocks have not done well over the last, you really go back, you look at the chart that Bloomberg put up. It really goes back to around May, which should sound familiar to everyone because we saw a huge change in economic mechanics around June, July, and into August. That's when we had the negative payroll report for the month of June. So even in the stock market, there's growing concerns that the consumer is going to drag the economy down. And if it does drag the economy down, what happens to the stock market? As we all know, the one thing that stocks sell off for, other than a bubble being burst, is an NBER style negative payroll numbers, maybe even negative GDP kind of recession. So the more that we get consumer weakness, the more we see confirmed consumer weakness, the greater the chances that will spill over into all these other places, including, as I talked about yesterday. If you haven't seen that video, you really do need to see it. I did this in the deep dive analysis too. Continued liquidity problems in private credit, the latest with Blue Owl, which is a name that should sound familiar. Blue Owl that, if they're don't want to get sidetracked here, but Blue Owl that got some redemption requests, decided they're gonna put those aside by engaging in a merger. A whole lot of stuff going on there, and all of that is also driven, as I keep pointing out, by the consumer economy. In this case, as a reflection of the labor market. So it really is the consumer part of the marketplace and everything else that should be on everyone's radar and everyone's focus from this point forward. So Target was today. Target earnings were not good. Not only were the earnings below expectations, it was also the same, the reasons why, which will also apply to when we get into what the Fed's minutes said or what the Fed minutes didn't say. So what Target said, we're predicting weak holiday sales. Same story, strain on consumer budgets. Sales were down in discretionary categories, further confirming the weakness across the entire consumer economy. And consumers themselves have been telling us the same thing, fears over jobs and incomes. And I think one of the most important aspects of it here, though, the average transaction amount increased 2.4%, but sales dropped 2.7%, which is what we've been telling you. There is no tariff inflation. There will not be tariff inflation. Instead, what happens, and this is one thing that Target pointed out, if they try to raise prices, volume disappears. Well, it doesn't disappear. When prices go up, volume goes down. And in the case of Target, volume goes down more than prices go up. So it's another indication of why there is no tariff inflation. And it's also related to the weakness in the labor market, fears over worse, layoffs, jobs, and incomes. So here we have a key bellwether retailer, Target, saying, Not only do we have bad third quarter results, we're not predicting anything good for the fourth quarter, which of course includes the holiday season. So weak holiday season expectations from Target, what they're seeing so far of it, even before we get to Black Friday. But as we know, Black Friday is no longer the kickoff that it used to be, nor as important as it used to be. You know, the holiday season starts really at the end of October and gets into November. So we've already got some information about what that's going to look like. And it's less traffic, fewer purchases, maybe paying a little bit higher prices, but consumers simply cannot afford this economy. That's why the term affordability is being used everywhere across the political spectrum, not just here in the US, but across basically everywhere. They call it affordability, but what Target is saying, what all the data says, especially when we go over here, is that it's not really affordability. It's labor market, it's jobs and incomes. There's not enough jobs. There's not enough income growth. There hasn't been enough jobs for years. And now it's really starting to seep in. And now it's really starting to impact the economy to the point that Santa is even angrier this year than he was last year. Last year was not a good Christmas season, though it was saved at kind of the last minute by the tariff and the artificial highs that showed up at the end of the year. There's nothing like that happening this year. And again, Target is one key piece of confirmation about why that is. At the same time, though, as Target reported weak results, TJ Maxx, the discount retailer, said, hey, we see some strong numbers here. And while that sounds like maybe a contradiction, it's actually not. This is one of those cases where, like Walmart, when Walmart's doing well, chances are the general economy is not doing well. And we'll find out about Walmart tomorrow morning. But TJ Maxx said, hey, our quarter started out great. We're doing well. And when discount retailers we see their business picking up, that's not a good sign of the overall economy. So the CEO, TJ Maxx, the owner of Marshalls, and what's the other story, Home Goods or whatever, they said quarter started out great, not a good sign for the overall economy. But even here, even as the season started off strong at TJ Maxx, what they also admitted was their holiday guidance still fell short of Wall Street expectations. So even though the discount retailer had maybe the best start to the Christmas season so far, they're still not all that optimistic about the rest of it moving on from here. So there's another big red flag where the only one who so far has reported decent earnings and decent numbers, especially revenue and the average ticket and all the traffic and all that stuff, they're still saying it's going to be a tough Christmas anyway, even though you would think that their success would continue. And then the other one from yesterday, Home Depot. Home Depot cut their earnings outlook was not good either. And this is something I've been pointing out all year as it relates to the housing market. Everybody said once interest rates start to come down, things are going to start picking up. And you would think that would pick up starting with the housing market and things related to the housing market, like the home improvement sector, Home Depot's bread and butter. Home Depot instead, they said the same. We had anticipated that demand would begin to accelerate gradually in the back half of the year as interest rates and mortgage rates eased. Again, not because of the Fed, but because of the marketplace. As we'll see, rates are continuing to go down, even if they're more sideways here than not. But as interest rates in the marketplace have gone down and mortgage rates have gone down, we have not seen a material pickup in the housing market, nor is Home Depot saying we're seeing a pickup in the home improvement market. So it's not interest rates. The weakness in both of those, the growing macro bust in the housing sector, is not about interest rates. Instead, it's about, as they say, consumer uncertainty, which, as we know, is just a euphemism for everything we just heard about from Target. Weakness in consumers can't afford to shop. So if they can't afford to shop at Target for regular goods, they're sure as hell not going to shop. They're not going to target big ticket items at places like Home Depot, even if interest rates are somewhat lower on the back end. So Home Depot again confirmed what the importance of Home Depot is. Yes, consumers are weak. Call it consumer uncertainty if that makes you happy, but it's really a story about jobs and income. In this case, clearly not one about interest rates, even though interest rates are supposed to stimulate the interest rate sensitive sectors of the economy. As we see here, this is historically consistent, low interest rates really don't do that kind of stimulus in conditions like this, because what matters more, jobs and incomes, not interest rates, jobs and incomes. That's what these retailers are telling us. And that's more confirmation from these big, giant consumer economy stories. Why is that? The jobs and income. So the government isn't reporting on the The October payroll report, we're not going to get that. That was the BLS announced that a little while ago here today. We'll get the September payroll numbers tomorrow, which I believe includes the household survey. Those numbers were already done. But the data that we have so far indicates that we're still seeing some degree, some low level of job shedding. So, of course, consumers are going to be increasingly cautious. Yes, there's those who are doing well, those who are experiencing the wealth effect of the AI bubble up until the last couple of weeks. Sure, they may be spending like they always do, the K-shaped economy. And I hate that term K-shaped economy because every economy is K-shaped. What distinguishes the good times, the real legitimate economic boom, from the bad times like a recession or forgot how to grow recession is simply how many people are in the bottom part of that K. You go back to the Great Depression. There are tons of people who did well during the Great Depression. There was a whole ton of people who didn't. That's what made it a depression. You go to a boom time, there's lots more people in the upper part of the K and fewer people in the bottom part. So what we're seeing here is confirmation that there's way too many people in the bottom part of the K. You want to call it a K-shaped economy, fine, but that doesn't really describe the situation that we're in the way that Target and TJ Maxx and Home Depot and a whole bunch of others that we've gone over recently are doing. And it's consistent with what we're seeing from the data that we do have on ADP employment and some of the other ones that we've gone over recently, especially Challenger and layoff announcements. Speaking of layoff announcements, impending layoff notices from the Warren system surged in October alongside what we got from Challenger, Gray, and Christmas. So speaking of Christmas, that's not going to lead us into a good period, a good holiday Christmas shopping period. So everything here is consistent. Consumer economy that is at best uncertain or questionable, but more reality than not, the consumer economy is stumbling here heading into the fourth quarter and into next year. And there is nothing that lower interest rates are going to do. As I keep telling you, lower interest rates are instead a reaction to the weakness that we're seeing, even if parts of the FOMC committee aren't convinced they need to lower interest rates. And like I said, we'll get into that in just a second. So the employment statistics that we do have are consistent with the numbers that we're getting from Target and all these others, showing that consumers are struggling. Call it affordability if you want, but it's really about what we're seeing here on the screen. Either the weakness in the job market that's already hitting consumers or fears that the weakness is going to get even weaker as we move forward. Remember, Jay Powell even talked about the flat part of the beverage curve. And in his Jackson Hole speech, he referenced the fact that when you get to the flat part of the beverage curve, going further down the flat part tends to happen relatively quickly. So as I mentioned, the BLS says they're not going to be able to do the October jobs report. What they said this afternoon was no household survey, that's not going to be done. There'll be a partial update for the October establishment survey, but that won't be delivered tomorrow or anytime. It'll be delivered with the November payroll report in the middle of December, which a lot of media commentary went crazy because that's after the Fed meets, and therefore the Fed won't have labor market data to convince it to cut rates. So the tariff inflation hawks on the committee are apparently on charge, or at least that's the narrative that's being spun right now. The market isn't actually buying that. As I said, consumers have been telling us this entire year they are afraid of unemployment. Yes, they are afraid of price changes, but they're afraid of price changes because they know they don't have the income to absorb even the smallest amount, as we saw with Target's report. And, I mentioned this before too, with the Conference Board's estimates of consumer confidence, which were also grim, reported earlier this month, excuse me. With that last report, the Conference Board also said consumers, they were not in the mood to spend on shopping. And so here we have the consumer confidence numbers, afraid of unemployment rising. In fact, more people in the University of Michigan survey think that unemployment is going to rise over the next year than at any time apart from May 1980. That's how certain consumers are. And consumers tend to be, especially in a group like this, a large setting, big data type of thing, wisdom of the crowds, consumers tend to be very good about economic conditions, certainly far and above, PhD economists that are working at the government or the Federal Reserve. So they have said, we're afraid of jobs and income, and we're not going to spend on Christmas because we don't have either the ability to do so, or we're afraid of what's going to happen either during the fourth quarter or in the early part of next year. And then the Target comes along, and TJ Maxx and Home Depot and probably Walmart too, saying, yes, we're seeing the same things that consumers are seeing. It's a comprehensive picture from top to bottom, and it looks increasingly like flat beverage. And it's just to show you that it's not the goods economy. The Federal Reserve Bank of New York put out its business leaders survey, which is really the services PMI. The services PMI for the month of November, by the way, this isn't even October, we're going into November. And while there was a slight improvement in the monthly figure from October, as you can see, that's not really a meaningful improvement. It's still on the way down, and it's deeply negative. And one of the reasons it's deeply negative, of course, the activity index was hugely negative, which suggests that business activity is still continuing to fall at a substantial rate. Services in the New York region, which is a pretty decent proxy for services around the rest of the country. And where it comes to employment, the employment index for the New York Business Leader Survey, services, all of that stuff, not only did it fall 3 points to minus 8.6, as the survey itself points out, that's the third consecutive negative reading and a multi-year low. So yet another data point that points to weakness in labor, that leads to weakness in consumer spending, that leads to weakness in business activity, especially if anybody tries to raise prices. And you can see where this is going. It's going exactly where we thought it was, in the direction of the flat beverage curve. Market reaction, I think this is important. I've talked about this several times recently. Bitcoin was hammered again today, down below 90,000 for the first time. In fact, it's down on a year-over-year basis. Pretty substantial decline. We're almost talking about 30% since the high from about a month ago. So you get to 125,000 and then down to around 90, in fact, a little bit below 90,000. That's a pretty big move. In fact, you look at that, the degree of the move in Bitcoin, it's actually slightly more than the decline in the chaos and deflation and disorder in stock market selling back in March and April, which suggests that sort of an early warning signal about the proclivity of risk asset buyers to buy risk assets and hold risk assets. Yes, there's some leverage that's involved in the Bitcoin reverse. I think there's a lot of profit taking because when you're more and more uncertain about economic conditions, or in the case of the stock market, you're uncertain about what's driving the stock market, whether it be the AI bubble or the narrative that the economy is just fine. Suddenly those things are being questioned. You start to sell the things that have done the best, the things that are easiest to sell. And I think that's why, to overuse the term here, Bitcoin could be a canary in the coal mine. You can see that it was earlier in the year. Bitcoin started to fall before the NASDAQ actually did. Although the NASDAQ was kind of sideways, but Bitcoin was already on the way down by the time the NASDAQ really got some selling. And we might be seeing the same thing develop here, though this is one to keep an eye on. But Bitcoin here is really potentially, like I said, an early warning signal that the risk part of the markets are starting to see the same things that we just talked about, which is why the Bloomberg article pointed out that Target and Walmart and Home Depot may be more important than Nvidia, especially moving forward. While everybody's going to focus on Nvidia, the state of the consumer economy, especially in the short run here moving forward, are really going to be the setting for everything, not just Bitcoin, but also even AI stocks. You get into more a perceived higher probability of something like an NBER recession, which would be leading in that direction if all the data we're getting continues to compound in that way. You get to an NBER style recession, nobody's going to care about AI whatsoever. Everybody's going to be heading for the exits. So that's one potential that we need to keep looking at. In fact, even the Federal Reserve in its meeting minutes that were released earlier today did talk about the stock market because, central bankers do that when valuations look like this, as ridiculous as many of them are. But the big thing was that this passage that I'm highlighting for you here in the meeting minutes, many participants suggested that under their economic outlooks, it would likely be appropriate to keep the target rate unchanged for the rest of the year. So the media has run with stories about divided FOMC. There's not going to be a December rate cut from the Fed. And like I always say, who cares? The Fed is only reacting to weakness to begin with, and without any labor market confirmation, maybe they won't have enough votes to do a December rate cut, maybe they pause, it won't really matter. The Fed is going to go back into the Pringles can at some point anyway, because that's where the economic weight of gravity is, whether or not they say so. And this is the same thing that not only have we seen so far in this rate cutting cycle, it has been irregular than some. It is historically what we always see in rate cutting cycles. The Fed will cut rates, or the ECB will cut rates, and they'll say, that's more than enough. We're worried about inflation. They did the same thing in 2008. If they did that in 2008, you should not be surprised they're doing it here in 2025. In the middle of 2008, the FOMC was discussing not just pausing the rate cuts. They had stopped at around 3% after Bear Stearns. Not only were they discussing pausing rate cuts for the rest of 2008, many officials were saying we need to start raising rates in 2008 during the worst crisis and monetary panic that we've seen since the Great Depression. This is not unusual. And as we talked about with Target, it's completely wrong to begin with. So all of these many participants who say if their outlook happens, they don't want to cut rates, their outlook's not going to happen. And we know that because Target told us that. Target's results show us there is no tariff inflation. The economic climate is not conducive to something like that, even if that's how inflation worked, which, by the way, it is not. But even if it was, the economic climate is not going to be one that tariff inflation is going to flourish within. You raise prices, volume disappears. That's not inflationary. That's quite the opposite. That's going to lead to margin pressures on retailers and wholesalers and manufacturers, and as we saw in New York, service providers. They're going to be cutting jobs to try to stay even, not going to be raising prices in some kind of inflationary spiral. So my point here is, yes, the FOMC is divided today, but who cares? Their outlook that they think is going to lead to, that they need to be cautious over, that says they need to pause interest rates, their outlook is just completely wrong. And the more we go through all of this data, this is the importance of Target and Home Depot and all these retailers, the more we see the evidence of it, the more we know they're incorrect. And the more we know they're incorrect, at some point, they're going to be forced to see it too. Maybe that's December, maybe that's the meeting afterward. It doesn't really matter in the end. The timing of the rate cuts, immaterial, because we know rates go down anyway. And that's why the market barely reacted. In fact, it wasn't really a reaction at all. Yeah, the Fed has absolutely no clue about any of these things. So you look at the interest rate market, U.S. Treasuries, still in the bull steepening channel. Even today, a couple basis point move in the Treasury market. Do you remember, everybody remember how interest rates used to react to the Fed? Think back to, say, March and April of 2024, just last year. The sticky inflation period, the minutes would come out and, oh my God, they seemed hawkish. It absolutely did provoke substantial moves in the Treasury market. Today, you got these hawkish minutes that suggest, according to the mainstream media, that the Fed isn't going to cut in December, and the Treasury market just kind of went, okay, doesn't really matter. So as you can see, the 10-year Treasury still in the downward channel that goes all the way back to January. 2-year Treasury, even though it's up off the September lows, still in the same thing, still moving in the same direction. We're still looking at bull steepening. And you can see the process. It looks like a stair-step pattern because that's how the market actually trades out. So even if the Fed isn't sure about what they're talking about or what they're seeing, or what this group is opposed by this group, the market still remains confident as ever. Rates are going to go down, and the shape of the yield curve, along with all the rest of the stuff that we talk about here at Eurodollar University, says rates are going to go down, and when they do, they go down by a lot, and unfortunately to stay there a long time. And so the data that we just got from Target and all these other retailers, plus the anxiety that's priced in Bitcoin over what that potentially represents, not to mention all the stuff I talked about in yesterday's video on the credit markets. Jeff Gundlach openly talking about garbage lending and how it reminds him of 2006. Yeah, more and more people can start to see it. So even if the FOMC, Jeffrey Schmidt and Alberto Musalem from St. Louis, they can talk about tariff inflation all they want, it's not actually showing up anywhere other than their fantasies and figments of their own imagination. What is showing up is the affordability crisis, or really the consequences of the affordability crisis, which is a labor market that is going in the wrong direction. And everyone apart from those people in the Federal Reserve can see it, even including the parts of the stock market. You saw with the Bloomberg chart there, even stock market is a little bit anxious about the consumer economy. That's why we don't see consumer discretionary stocks perform as well as the rest of the overall market. So that's what we got for today. Nvidia is going to dominate the headlines, but the real data, the real confirmation, Target, Home Depot, even TJ Maxx to an extent, and probably Walmart tomorrow. And if Walmart really knocks it out of the park, That's another red flag. And we know why that's the case because we get all the rest of the confirmation. Yes, and look for the September payroll report, though. At this point, the BLS always overstates payrolls to begin with, and it's a couple months old already. So don't really know how much of an impact we'll have on September payrolls. But thanks everybody for joining me on a Wednesday evening. Good luck with Nvidia and everything else. I'll see you all again very, very soon.